be in EV cars, and they have fulfilled that. And now they're doing amazing, amazing global concentration of advanced batteries for storage, and they're exporting of electric vehicles into Europe and Canada and South America is extremely high. So the point is, they have been able to migrate into alternative energy sources, massive solar farms, massive battery science focused advancements, not to mention EV at the core, plus wind. So they are really in a situation where they might still be dependent in a year from now on falling oil supplies from both Venezuela and Iran, worst case, but they have been preparing for it. So they actually have a lot of miles they can go before they are stressed.
So let's switch gears for a second and talk about the market reaction, which I think has been quite sanguine. I think it has been we've certainly had this dramatic V-shaped recovery over the past couple of weeks, and there's this sense now that there will be a resolution in the short term in some form. Do you think that this is over optimistic? Do you think that this rally has been one that's been perhaps too soon, too much too soon?
The rally is very, very much mechanical as it relates to the end of quarter buying. And I know this is very hard for most folks who are focused on macro and looking at Iran risk not priced in. We got obviously some repricing in equities during the month of March. But at the end of the quarter, there is mechanical buying that takes place. And then that is fed by more mechanical buying. These are quant insensitive buyers that are moving with the direction of the market and have lots to buy, basically. And then you have the ceasefire headline that came on April 8th, which created a peak to trough gap up of 5%, which was a very large short covering trigger. So you started out with end of quarter flows and you went into mechanical buying that picked up speed. Then you had the ceasefire headline, which is a nightmare for bears that were holding short, and they were basically holding on to long positions, but fully hedged. So those hedges then very aggressively had to come off, which begets buying. And then that triggers what's called the dealers to also have to chase. There's a lot of optionality in the market where the option market that is dealer hedged then has to cover. And as folks are basically selling calls above to above their positions, as the market is running into those calls or these overwrite strategies, it requires even more short covering. And then institutions started coming in, and then retail started coming in. So, yes, this 13-day advance in markets was historic. Historic. But it was all starting with mechanical buying and then the ceasefire headline with short covering institutions and retail, and it will peter out. And then the market can price in fundamentals. Right now, we're in the grip of earnings season, and typically, earnings season creates this kind of volatility suppression, which means we kind of want to see how they do before we reprice equities. And right now, earnings estimates have been ratcheted higher, especially for tech, especially for tech. The AI ecosystem is still very resilient and very hopeful. So, long story short, fundamentals have not been re-rated lower. The macro backdrop absolutely is still not safe as it relates to sustainable oil prices and supply shocks, but they were priced out.